as we all know from studying these things in the past, when you have a bull market in precious metals, silver vastly outperforms gold. And so I'm very bulled up and excited about silver, and my fund is focused on a lot of the silver miners for just that reason. And I expect gold, in a year to say, let's say it's 3,500. Kind of conservatively. I think silver is going to break through 50, probably be $75 or $100 within a year or two. So, which is as a multiple, when it's at 30 now, that's a much higher multiple than the growth in gold. So yeah, they're related. And but silver, just as we'll get to Bitcoin, but silver's more volatile than gold. Right? There's a price to pay. Okay, so silver could outperform gold. Great. Yeah, that's the good news. The bad news is it goes down faster than gold too. The cracks that I am seeing is that while they, and this is the pattern of the Fed, they tend to break things and then they do emergency measures and get things back under control, and then they break again. And so the last thing they broke was they broke the no inflation, conditions that they had pre-COVID. And, COVID came along, they grew the money supply 40%, and suddenly we had 9% inflation. It was raging. And they realized they'd overshot on the money printing and they'd been too loose for too long. They were still doing QE and buying bonds late into the, once inflation was already going, they were claiming it was transitory. It wasn't. And they tightened like crazy and they sent everything in the other direction. And so that's the regime we're in now, where they have brought inflation down, not to what they hoped to bring it down to. They hope to bring it to 2 or below. They're not there yet. They're in the 3s. And there's some indications that it's maybe starting to turn back up, but whatever. What I see that the bigger problem that I think the Fed has is actually more at the United States federal government fiscal level. And this is what happened just in a nutshell. When COVID came along, federal government spending really went up. I gave a presentation at the show earlier, and it's available on my X feed, that shows a chart which shows that pre-COVID, the government was spending about $4 trillion a year. COVID came along and that suddenly went up to 6.5. Really, really rapid expenditure growth, obviously to counter a pandemic and an emergency. But the thing is, when the pandemic was over, you would have thought it might come back down, and it didn't. It stayed high. In fact, it's gone up. This year it was just 6.75 trillion. And in an economy where the stock market is at record highs, employment has recovered from the COVID dip, inflation has come back down a bit, still running very big deficits. Last year's deficit was 1.8 trillion. And with the last 6 months annualized, the deficit's now 2.4 trillion. And so the problem there is that adds to the debt. And so the debt is growing very rapidly. We just crossed 36 trillion. And the problem with that is that with these higher interest rates that they put in place to beat inflation, suddenly the federal government interest expense has gone straight up. And so there's also in my presentation a chart, and most people have seen this chart, that shows U.S. federal government interest expense for the last 15 years. And it kind of trends nicely, slowly up, and then suddenly it just goes vertical. And so we are now spending about $1.2 trillion a year on interest. It's more than we spend on defense. It's almost as much as we spend on Social Security. The interest on the debt has really caused the fiscal problem. And so what that then leads to, the follow-on knock-on effect of that, is what I call a fiscal doom loop, or other people call it fiscal dominance. A lot of ways of looking at it, but it's pretty simple.
The global economy is at a crossroads. While markets have seen fluctuations, one thing is increasingly clear. Gold and silver are gaining importance as strategic assets, both for individuals and nations. Larry Lepard, a seasoned investment fund manager, has consistently advocated for precious metals as a cornerstone for preserving wealth, especially during times of economic uncertainty. Today, we'll delve deeper into the key points raised in the provided discussion and examine why gold and silver are not just alternatives, but necessities in the current economic climate. Let's start with silver. Historically, during bull markets in precious metals, silver has consistently outperformed gold in terms of percentage gains. It's often said that when gold runs, silver sprints. Lepard expects this trend to hold true in the coming years. With gold predicted to reach $3,500 per ounce within a year or two, silver could easily break its previous high of $50 and climb to $75 or even $100 per ounce. At today's price of around $30 per ounce, that would represent more than a threefold increase. Why does silver outperform gold? For one, silver is more volatile, meaning its price swings are more dramatic in both directions. While this volatility can scare off some investors, it also provides opportunities for those who are willing to weather the ups and downs. In addition, silver's dual role as both an industrial metal and a monetary metal gives it unique leverage in times of economic uncertainty and technological advancements. However, The volatility of silver isn't for the faint-hearted. As Lepard aptly puts it, there's a price to pay. When markets dip, silver often falls faster than gold. But this downside risk is offset by the potential for outsized gains, especially when inflationary pressures and geopolitical uncertainties converge to drive up demand. One of the recurring themes in Lepard's analysis is the Federal Reserve's tendency to break things. Over the years, the Fed has oscillated between periods of loose monetary policy and aggressive tightening, often overshooting in both directions. For instance, the Fed's response to the COVID-19 pandemic included an unprecedented 40% increase in the money supply, which inevitably led to inflationary pressures. When inflation hit 9%, the Fed scrambled to tighten monetary policy, raising interest rates at a pace not seen in decades. This pattern of breaking and fixing is emblematic of a reactive rather than proactive approach. While the Fed has managed to bring inflation down to the 3% range, it has not yet reached its 2% target. Furthermore, there are signs that inflation could start ticking back up, especially given the structural imbalances in the U.S. economy. Lepard argues that the Fed's challenges pale in comparison to the fiscal crisis unfolding at the federal government level. Federal spending, which surged during the COVID-19 pandemic, has not returned to pre-pandemic levels. Instead, it has continued to climb, reaching $6.75 trillion this year. This has resulted in ballooning deficits, with the annualized deficit now standing at $2.4 trillion. The consequences of this fiscal profligacy are becoming increasingly apparent. As interest rates rise, the cost of servicing the federal debt has skyrocketed, now exceeding $1.2 trillion annually. To put this in perspective, the U.S. government spends more on interest payments than it does on national defense, and almost as much as it spends on Social Security. This dynamic creates what Lepard calls a fiscal doom loop. Higher interest costs lead to larger deficits, which in turn require more borrowing. The increased supply of bonds pushes interest rates even higher, perpetuating the cycle. Foreign buyers, once a reliable source of demand for U.S. Treasury bonds, have been steadily reducing their purchases for the past decade. Without sufficient buyers, the government may eventually be forced to resort to measures like yield curve control or outright bond monetization, both of which would exacerbate inflation. The writing is on the wall. The U.S. economy is heading toward a fiscal and monetary crisis, and the window for corrective action is rapidly closing. While no one can predict the exact timing of these events, the underlying math is undeniable. Debt and interest payments are compounding at unsustainable rates, and the government's ability to manage these challenges is increasingly in question. For investors, the message is clear. Gold and silver are not optional. They are essential. These precious metals offer a hedge against inflation, currency devaluation, and systemic risk. By allocating a portion of their portfolios to gold and silver, investors can protect their wealth and position themselves to benefit from the inevitable revaluation of these timeless assets. As Lepard aptly puts it, we may not know the exact timeline, but we know where this is heading, and the wise investor will act accordingly.
Your interest cost is higher, so it's a bigger number. That bigger number goes into the budget. Your tax revenues haven't gone up that much, therefore your deficit is bigger. How do you take care of the deficit? You sell bonds in order to fund the deficit. Well, the bonds go into the market for interest rates, same amount of demand for interest rates, more supply of bonds. Oh, how do you solve that? Interest rates go up. Oh, but interest rates go up means the government's interest cost goes up. Deficit gets bigger, and rinse, wash, repeat. So it's a, I call it a doom loop. It's a vicious circle in the wrong direction, which I believe will ultimately lead to the government having to say, okay, this isn't going to work. We are going to institute yield curve control or QE, or we're going to buy the bonds, because they're having a hard time finding people to buy the bonds. A lot of the bond auctions have been weak, and the government, foreign governments and foreign people aren't buying the bonds the way they used to. Net foreign buying has gone down consistently since 2014. That's 10 years of a downward trend of foreigners buying our bonds. And, we're going to pretty soon find that we're kind of like a third world country. And what this is, put in personal terms, this is like somebody who has too much credit card debt and they are having a hard time making the interest payments, the minimum payments, so they go get another card, and then they draw on that and they use that to make the minimum payments on the other, and then when that gets bigger, they go get another card. And it's just, you're borrowing to pay off the interest on what you've already borrowed, and it just can't go on forever. I define that as Stein's law, which is if something can't go on forever, it's going to end. And it appears to me like this is getting to the point where it's kind of getting critical. And I think, you've even had some pretty large, high-profile, establishment people say, we've got a fiscal problem here. So then that begs the question of what are they going to do about it, and that's a whole other question. I wrestle with that. First of all, nobody knows, right? Nobody knows. But I will make a couple of observations. It appears to be getting more and more critical. The lines are getting steeper, on the debt and on the interest. And they're compounding, and so that, I would say it's getting worse. And so I feel like this problem or crisis is going to come to a head in the next couple of years. They're pretty good at can kicking, so I'm totally willing to accept the possibility that, we're now in 2024, and I'm, thinking of this in fourth turning terms. Maybe it stretches out to 2030. Maybe it's another 5 or 6 years. I just don't see it going much beyond that. I think and it's really, Joe, it's actually really just kind of the math. When you when you grow, when you compound, I don't think people understand the way compounding works. And so when you compound your debt and you compound your interest, it's really hard to get out of the trap. Go back to the credit card, the family with the credit cards. Generally the way that gets resolved is they file bankruptcy, and start over again. Maybe the U.S. is going to go bankrupt. It's extreme. There has to be something very radical that takes place to restructure it and fix it. A very visionary leader with a ton of courage could maybe pull that off, but even that leader, the people would scream and yell. And so my sense is what will unfortunately happen is we will just keep running down this road, and we will have higher and higher and higher inflation, perhaps even something looking close to hyperinflation. And at that point in time, it will be so bad and so painful, and everyone will be so mad that they'll say, okay, I don't care how much pain it's going to take. We got to fix this goddamn thing. And I'm willing to get sober. Do you know what I mean? And so let's go back to sound money, even if the first year of it is awful. What we're living in right now is pretty awful too. So you see what I'm saying? So that's kind of how I think it gets solved.
Let's start with silver. Often overlooked in favor of gold, silver holds unique properties that make it indispensable. Beyond being a store of value, silver's industrial applications are vast and continually expanding. From solar panels to electric vehicles, its demand is woven into the very fabric of technological progress. According to a report by the Silver Institute, the demand for silver in the green energy sector alone is expected to grow significantly in the next decade. Every solar panel requires silver, and as the global push for renewable energy intensifies, this demand will soar. Similarly, the automotive industry is transitioning toward electric vehicles, each of which requires up to 3 times more silver than traditional combustion engine cars. Lepard's projection of silver hitting $75 to $100 within a year or two is rooted in these fundamentals. When you couple industrial demand with silver's historical role as a monetary metal, you get a potent combination that can lead to explosive price movements. During bull markets, silver has consistently outperformed gold, often by a multiple of 2 or 3. This volatility is both its strength and its risk. Investors must understand that while silver's upside potential is immense, its price swings can be sharp. The strategic importance of silver extends beyond its monetary and industrial roles. Governments and militaries worldwide are increasingly recognizing its value. For example, silver is critical in the defense sector, used in high-tech weaponry and communication systems. A Tomahawk missile, for instance, requires 500 ounces of silver. As geopolitical tensions rise, the demand for these technologies grows, putting additional strain on already tight silver supplies. This demand is why countries like China and India are aggressively accumulating silver. In 2023 alone, India imported nearly 300 million ounces of silver, while China has been buying both refined silver and silver concentrate at unprecedented levels. Russia, too, has recently announced its intention to add silver to its national reserves, signaling a recognition of its strategic importance. What makes this accumulation even more intriguing is the opacity of the silver market. As Lepard highlights, the COMEX and LBMA, London Bullion Market Association, are rife with rehypothecation, where the same ounce of silver is effectively sold multiple times through paper contracts. This creates an illusion of supply that doesn't exist, masking the true scarcity of physical silver. When the reckoning comes and buyers demand delivery of their contracts, the resulting short squeeze could send prices skyrocketing. Moving back to the broader economic picture, The U.S. government's fiscal policy is a ticking time bomb. Lepard's concept of the fiscal doom loop captures the essence of the problem. Here's the cycle: rising debt. The U.S. government is adding to its debt at an alarming rate, with $36 trillion already on the books and annual deficits now exceeding $2 trillion. The debt is compounding at an unsustainable pace. Higher interest payments. As interest rates rise, so does the cost of servicing this debt. The U.S. now spends over $1.2 trillion annually on interest alone, more than it allocates for defense. Bond market weakness. Foreign buyers, once reliable purchasers of U.S. treasuries, are stepping back. Net foreign purchases of U.S. debt have been declining for a decade. This forces the Federal Reserve to step in, printing money to buy bonds and artificially suppress interest rates. Inflation. The Fed's bond buying programs lead to monetary expansion, devaluing the dollar and eroding purchasing power. Inflation becomes entrenched, forcing the Fed to tighten monetary policy, which in turn increases interest costs. Repeat, the cycle begins anew, with each iteration bringing the system closer to collapse. This doom loop is not sustainable. At some point, the Fed will have to intervene with extreme measures, such as yield curve control, capping interest rates by buying unlimited bonds, or even outright monetization of the debt. Both scenarios would be highly inflationary, further eroding confidence in the dollar. Gold's role as a safe haven becomes even more critical in this context. While silver offers greater upside potential, gold provides stability. Central banks understand this, which is why they've been net buyers of gold for over a decade. In 2023, central bank gold purchases hit a record high, with over 1,200 metric tons added to reserves. Why are central banks hoarding gold? The answer lies in its unique properties. Gold is no one's liability. It doesn't rely on the creditworthiness of a government or corporation. It's a tangible asset with intrinsic value, immune to inflation and currency devaluation. In a world where fiat currencies are losing trust, gold is the ultimate fallback. Lepard's projection of gold reaching $3,500 within a year or two may seem ambitious, but it's well within the realm of possibility. The factors driving this forecast include geopolitical tensions. From the Russia-Ukraine conflict to rising tensions in the South China Sea, geopolitical risks are high. Gold thrives during uncertainty. Central bank policies. As the Fed and other central banks grapple with inflation and slowing growth, the return to monetary easing is inevitable. This will weaken fiat currencies and boost gold. Dollar weakness. The dollar's status as the global reserve currency is under threat. A shift toward a multipolar currency system, with gold playing a central role, would send its price soaring. The case for Bitcoin. While Lepard is a staunch advocate for gold and silver, he acknowledges Bitcoin's role as a digital alternative. Bitcoin's decentralized nature and fixed supply make it an attractive store of value in the digital age. However, Lepard is cautious about Bitcoin's correlation to speculative assets like the NASDAQ 100. He views Bitcoin as complementary to gold and silver, not a replacement. Bitcoin's potential lies in its ability to attract younger, tech-savvy investors who may be skeptical of traditional financial systems. As adoption grows, Bitcoin could carve out a niche as a digital hedge against inflation. However, its volatility and reliance on technology make it less reliable than gold and silver for long-term wealth preservation. So what should investors do? Lepard's advice is clear. Allocate a portion of your portfolio to precious metals. Gold and silver are insurance policies against the systemic risks facing the global economy. They're not just assets, they're lifeboats. For silver enthusiasts, the opportunity is particularly compelling. With prices still well below their historical highs and demand set to surge, silver offers unparalleled upside potential. For those seeking stability, gold remains the cornerstone of any sound investment strategy. The economic landscape is shifting, and the signs are impossible to ignore. From the fiscal doom loop to the rising demand for silver and gold, the case for precious metals has never been stronger. As Lepard often says, we don't know the exact timing, but we know the direction. The choice is yours. Prepare now or face the consequences later. By investing in gold and silver, you're not just preserving wealth. You're taking a stand against the unsustainable practices of fiat monetary systems. In an uncertain world, these timeless assets offer the certainty we all need.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.